Before we start the show, I must remind you that I am not a financial advisor, and this channel is sponsored by the XX Network. I'm in a competition with myself, and I'm losing.
The ways in which we trade our value, so to speak, as humans, as entities, that will just become mediated by that.
That's right. And I think the graph would be on the x-axis is the number of people in the world, or the percentage of the world, and the y-axis is the percentage of net worth on chain, right?
Yeah.
And so in 2009, perhaps only Satoshi had, actually even Satoshi didn't, because Bitcoin is worth less than $1 or whatever, didn't have a value. Let's say 0% of the world had 0% of their assets on chain. 5 years later, less than 0.1% of the world had some percent of their assets on chain. 10, 15 years later, by 2022, I don't know, it might be, so of the 300 million people, that's about 5% of the world, right? Maybe 1% of the world has 10% of their assets on chain, or whatever the number is, 5%, I don't know the exact number, right? And so that's a little bit more of like a rectangle than a square. It's like a small demographic that has a large fraction of their assets on chain, and then it kind of drops off like this. And I think as we go 3 years, 5 years, et cetera out, I don't know, it's a very ballpark.
Long tail. Long
tail, that's right. And by, I don't know, 2030, but certainly by 2040, I would expect it similar to where we are now, where 50% of the world has 50% of their assets on chain.
Money isn't real. Only certain people with permission have the power to create it. The Fed issues reserves and gives it to the banks. And then the banks create 10x as much money from those reserves. The checking account you have isn't backed up by actual dollars in a vault. It's backed by the banks saying that you have it, and they will give it to you at will. It's all a confidence game or a con game. But crypto promises to account for all of the world's wealth in token form. And that's going to happen. Your checking account is going to turn into a Bank of America stablecoin that's called commercial bank money. Certain entities will have the power to create money on chain. The chains that account for the most wealth and are used the most will be the chains that win.
These are terrible reasons for the world's central banks, and especially the Fed, to jump headlong into the highly complex world of digital currencies. To begin with, as we have talked about at the outset, the notion that only the state may issue money and that the issuance of money by a private company is a threat to national sovereignty is puzzling to the point of incoherence. Almost all the money in the world is private money. It is claims on commercial banks. The only money you have that's issued by the Federal Reserve is the money you use to pay tips, and now I understand people are doing that with Venmo. I can never figure out how to do that. It takes me 20 minutes to tip with Venmo, so I still use the cash, but that's the only use I have for it. So the issuance of money by private companies through digital mechanisms like stablecoins is a new technology, but it is hardly a new concept.
As we know, crypto has the potential to disrupt the traditional banking system in a major way. Even though this is possible, it's also very likely that there will be a transitional period where existing laws favor banks. The status quo has the advantage. It's uncertain if regulators will grant smaller companies like Circle or Paxos licenses to be stablecoin providers, but the banks are a certainty. They already have their licenses. RippleNet offers hundreds of banks a suite of tools with the capability to build stablecoins on top of the XRP ledger. Given the right circumstances, such as clear laws and stablecoins, the banks can issue their stablecoins immediately. Why would Bank of America use Circle's USDC product? They wouldn't. They'd create their own Bank of America dollar on any ledger that had utility.
The strength of the United States dollar rests on many factors. The dynamism and size of the U.S. economy, our vast trade linkages throughout the world, deep financial markets, political stability, strong law and property rights, the ease of exchange and conversion, the presence of a credible monetary policy, at least up until the last little bit. None of these factors is going to be threatened anytime soon by a foreign currency, any foreign currency, certainly not, because that foreign currency is in tokenized digital form. It would be like saying, the Chinese have started printing the renminbi on purple paper and we're still using green, and we've got to catch up. Now, recently, I think realizing that after 10 minutes thought, those reasons for adopting a CBDC are not actually that compelling, the central banks of the world seem to be settling upon a third reason, which is there are 94 central banks of the world that are currently in the process of either considering seriously or implementing a central bank digital currency, and the United States will be forced by circumstances to follow suit. Well, our oldest son is 23 years old. And our youngest child, is a daughter, is 18, just turned 18 a few months ago. She started college. You do the math, that means that we are wrapping up about a decade of raising teenagers. So I am familiar with the argument that everyone else is doing it, so I have to too.
This is called the Stable Act. This is proposed regulation, and it specifically says that a stablecoin issuer needs to obtain a banking charter. It also says that the issuer of stablecoins would be able to get FDIC insurance. They'll have reserves from the Fed, and that all stablecoins can be readily converted into US dollars on demand. So Lael Brainerd from the Federal Reserve talked about creating a wholesale CBDC that goes to the stablecoin provider. So let's say a stablecoin provider has $100 worth of wholesale CBDC. They hold that and then they issue $100 to retail. That is their stablecoin, right? So RippleNet has 300 plus banks on their network, and this is an older figure. If you go back to 2018, they were saying 300 plus. So we've heard Garlinghouse say that they sign different banks every 2 weeks, and they gave some type of figure. So 300 is probably a low number. That was the official number a few years ago, and everyone that's connected to RippleNet, all it takes is a software update and they'd be able to create a stable coin on demand whenever they want, right? And this whole network, if it's used on the XRP ledger and you see, these banks get regulatory clarity to actually create stable coins, it's an extremely bullish case for crypto in general. All of the banks that use whatever ledgers, and 300 plus of them are using RippleNet, and we've seen this with Navati. Navati has issued stable coins on XRP as well as XLM.
And then the third one that we're seeing, and I think in many ways the most exciting, is that we're seeing central banks ask themselves, as crypto asset ecosystems evolve and emerge, do they need the means to project a central bank liability directly into a crypto asset ecosystem? And so that is to say, do you want your money printed by your central bank to have an equivalent instantiation within, say, the Ethereum or the Solana ecosystem, so that when you went to make a payment in that ecosystem, rather than needing to use a privately issued stablecoin, you could use a direct central bank liability, whether that's at the individual level or whether that's at the institutional level. We've heard Governor Lael Brainerd at the Federal Reserve talk about the potential to create a digitally native dollar-based settlement asset that could actually sort of form a platform for interoperability between stablecoins. That would be more kind of a wholesale approach. But I think those are the three big categories that I'm seeing. They're about control over your economy. They're about extending new ultra-low-cost payment systems to people who haven't previously been included. And they're about, bringing your currency into the new world of crypto.
Jesse McWaters leads MasterCard's global policy team. He used to work at the World Economic Forum. Consortia of incumbents have trialed different use cases. Energy Web Token has partnered with Google for trialing and creating use cases with smart grids and carbon credits. SingularityNet partnered with Cisco for distributed artificial intelligence. Hedera partnered with LG and other platforms, and the list goes on and on. RippleNet is not just a proof of concept. Banks are using it to bring down the cost of cross-border payments. Now, Ripple offers a bunch of different products that may involve XRP or may not. But the key for all of this going mainstream is for money to be safe and regulated. Whether that is through a central bank digital currency or stablecoin, it doesn't matter as long as it's convertible for dollars or fiat. The incumbents can't use a platform that doesn't have safe money. When safe money enters crypto, utility can triumph, and the more money hosted on crypto networks, the larger the market cap grows.
to build upon what Jesse just outlined, I see the primary difference across the different CBDCs to be the government's approach to privacy. And I say this because as someone who was formerly with the Fed, I can tell you that the Fed has no interest in your data. They don't want to know who, your name, who's using that CBDC, how much, where that transaction occur, when did it occur. That kind of data is very private, and it's a responsibility as well as a burden to maintain. So central banks like the Fed are not interested in private transactional data. But other countries are more comfortable with collecting that kind of.
As someone who has worked for the U.S. Treasury, Bank of International Settlements, Federal Reserve, Linda Zhang is now a major advocate for crypto innovation. She argues that the Federal Reserve doesn't care about what we're doing with our money. This could be great if it's true, but I have my doubts. Money is based on confidence, and if the Fed creates a CBDC without privacy built into the code, it will only cause more doubt. Right now, big tech is using our data against us, and banking regulations force fintechs and others to know their customer, meaning we have to give up information about ourselves to get a bank account. If the USA truly cares about privacy, the CBDC will take precedent, and having privacy built into the code. Something like this may sound surreal, but there are acts like the eCash Act being proposed to keep the CBDC as anonymous as cash. If the USA were to go down this road, they would look to nations like Switzerland that are already trial running their CBDC with CMIX. CMIX is a mixing network that's used for the XX network.
Was really to create a single pool of liquidity. And in fact, that's not even a novel idea for digital asset people. We have been, as an industry, looking for this single pool of liquidity and a global collateral pool. So in liquidity, you think about cash, and in a global collateral pool, you think about all your assets as well. This has been like the holy grail for the longest time, because whilst we've got relatively effective security settlement systems, payment systems, it's a bit of a disjointed mess. Each individual piece is separate and they don't link up particularly well. So
the banking industry has been talking about the benefits of a single pool of liquidity for a while now. Ripple CTO David Schwartz has talked about tapping into public pools of liquidity in several interviews. Pretty soon, the Automated Market Maker, or AMM, is going to be voted on and available to the XRP ledger. The AMM is going to allow everyone to contribute liquidity to this network. Ripple has worked from the top down and made partnerships with large banks. The XRP community will be able to stake liquidity for one large open source of liquidity. The RippleNet partners will have the option to use this single liquidity pool. And a while back, there was a patent that came out called XPool. That was a pool of liquidity for XRP. So that was a secret document that somebody dug up called XPool, and Ripple execs wouldn't comment on it.
As those 15 banks were thinking a little bit about the future of digital assets, they had a little mind, and I'll leave it at a little mind. Not all 15 of them got this, and not all 15 of them got this equally well. They had a little mind, said, well, actually, it'd be great if, when we do all this stuff in a new design, we could just, each of us have one pot in each currency.
In 2014, there was a proof of concept with R3, 12 banks, and XRP. The host said 15 banks, so I don't know if the digital asset trial he was talking about was this one specifically, but it makes sense to me.
One goal of the whole means of payment part, that project work aimed at, and then the finality in that was deal with means of payment on chain, but also create something that says zero risk weighted asset. And that's what drove all of that work. And then post-work in finality, I did some work with the guys here in Switzerland with SDX, the SIX digital exchange, which is the first to get up and be regulated as both an exchange and a CSD. And that was some more recent work. And along the way, this got very involved in lots of these conversations, working groups, panels, talking about what does it take for us to get this new digital asset infrastructure up and running.
Ripple and Six invested $72 million into KeyRock. KeyRock is a market maker. The host talked about digital asset infrastructure. Tim Grant, the head guy at Six, was introduced to crypto by Chris Larson. KeyRock is a market maker, so they contribute liquidity to platforms. They lend pools of liquidities for both buyers and sellers to use. Recently, KeyRock CEO spoke at Swell.
When you have systems like AMMs, basically they make it a lot easier for any market participants to effectively provide and kickstart the liquidity in an asset that just got recently listed. So for the challenges, for example, that you were mentioning, Richard, for everything that is getting liquidity for altcoins and smaller assets, I think that AMMs and the overall growth of decentralized finance has been extremely positive. And when I look at the long-term perspective on the market, I don't think there's going to be centralized or decentralized. I think that it's going to be centralized and decentralized depending on which step of the value chain of exchanging value you're actually looking at. Because some have advantages to be decentralized, some have advantages to be centralized.
The Internet of Value will allow anyone to send money as fast as information moves today. For this to happen, there needs to be deep liquidity. The AMM will allow anyone and everyone to stake their liquidity. When this market is deep enough, there are big players on the sideline looking for cheaper methods, and public pools of liquidity is what the bankers have been fantasizing about. Hello, and thank you for watching my show. I partnered with the XX Network because I believe in their mission to educate people about the importance of privacy. The XX Network is a proof-of-stake, quantum-resistant, privacy-enabled network started by David Chaum. Switzerland has recently hired Chaum to work on their CBDC called Project Tourbillon. The project is using CMix, which is a mixer for the XX Network. If you're interested in learning more about the XX Network, please visit xx.hub.network. I hope you all enjoyed the show. Please let me know in the comments what you liked or disliked, and if you have any constructive criticism. Can't you see it all makes perfect sense, expressed in dollars and cents, pounds, shillings, and pence? Can't you see it all makes perfect sense?